I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, Ellen Brown. Ellen Brown is of the popular website ellenbrown.com, also known as Web of Debt blog. Ellen Brown, thank you for joining us today from California.
Thanks, Greg. Great to talk to you.
I just want to extend your introduction. You're an expert on public banking. You are an attorney. You've written a dozen books. You've got another book coming up. We'll talk about that at the end of the interview. But you wrote a stunningly frightening article. And the reason why it's so stunningly frightening, as an attorney and as a good writer that you are, that you sourced everything and it's real, which is what's so frightening. It's like, oh, that they can do that, and it's about bail-ins, that you were on this website, USA Watchdog, about this time, talking about the G20 setting this all up for the world, that they can not, use taxpayer bailouts. They can use the money in the banks. Can you tell me why that you think that life savings, your words, life savings could be wiped out in a derivatives collapse?
Well, the bail-ins have started in Europe, but we in the U.S. are actually more vulnerable because under the Dodd-Frank Act and the Bankruptcy Reform Act of 2005, derivative claimants go first in a bankruptcy. So they're actually exempted from the bankruptcy rules, which require a stay, an automatic stay, where you can't. So the derivatives claimants can go in and just grab the collateral. And because we have a huge derivatives exposure here of 47 trillion the last time I looked for 5 U.S. banks, they could take all the collateral and there could be nothing left. I mean, theoretically, your deposits are covered by FDIC insurance, which insures up to $250,000. But the FDIC stands in line behind the derivatives, and so do the state and local governments, who consider their deposits secured, just like the derivatives are. But the derivatives people get to take their money first. Those are the insiders. They're the banks betting against each other primarily.
And this is what it means. In your article, you talked about derivatives have superiority over security. Superiority over securities. Does this affect pensions as well?
They have super priority over everything. So it's your deposits. They're the creditors. All the creditors are covered in a bail-in. All the creditors' money will be taken in a bail-in. So a bail-in is like the opposite of a bankruptcy, where in a bankruptcy, the bank is liquidated in order to pay off the creditors. In a bail-in, the creditor's money is taken in order to keep the bank alive. So we get to die while the bank lives instead of the reverse. So they specifically say creditors, which obviously means shareholders and bondholders. But what most people don't realize is that depositors are also considered creditors. When you put your money in the bank, it becomes the property of the bank, and all you have is an IOU. So the bank can do what it will with your money, and they're allowed to gamble in derivatives. This is since Glass-Steagall was repealed in 1999. So now that whole pool of fund is commingled, and they can do with it as they will. Like, there was an exemption for 5% of their derivatives, which were clearly gambling, right up till a year ago, December, when the Citigroup slipped into the Cromnibus budget bill, a rider that eliminated even that 5%. So now all their derivatives can be done in the depository arm of banks, which means they're gambling with our money and they can lose our money, and that the FDIC covers it. In other words, that is supposedly insured money.
Well, that's insured, but the FDIC has $50 billion?
Right, $67 billion. The last time I looked, they have a credit line of $500 billion with the Treasury, but that's just a credit line. First of all, it's a debt, and who's going to pay it back? It would have to be paid back by the banks who pay the premiums for the FDIC. And when they went over budget by $8 billion in 2009, I think it was, it nearly broke the little banks. So if they can't afford the premiums on an $8 billion deficit in the FDIC fund, what would a $500 billion deficit look like? And even that's not going to be enough for a $10 trillion derivatives bust, which is what Elizabeth Warren and another politician, they had a study done to determine what their liability was, the taxpayers' liability was, just from that rider of last December in the omnibus spending bill, and they said it was a $10 trillion derivative liability just for that 5%. And that includes the oil derivatives, which, if you ask me, are like real throat clutchers.
Well, the oil derivatives are all the leverage on top of the oil debt, and of course we know that oil prices. Everybody's like, "Woohoo!" I'm paying less than $2 a gallon in most places, in many places, for gasoline. But there's a big downside, and that is that people aren't going to get. There's not enough profit there for the bonds to be paid. Correct?
Yeah, and then the question is, why did oil plunge like it did? It looks like political warfare. Well, I have a theory on that. We could go into it if you want.
Yes.
I read this, and it looks pretty credible to me. John Kerry met with King Abdullah of Saudi Arabia in August of 2014. And before that, in June, I think, oil was at one of its all-time highs. It was something like $116 a barrel for Brent crude. And then last month, it was down to $38 a barrel. So it totally plunged after John Kerry met with King Abdullah. And some people, it was rumored that the goal of this, that they agreed that Saudi Arabia would flood the market with oil and bring the price down, and the purpose would be to get Russia and get Iran, which didn't necessarily work. But you could envision that Kerry may have said something like, well, don't worry, you'll take losses, but we'll cover your losses. But of course we can't just pay you directly, because that would be too obvious. So what we'll do is you buy derivatives protecting your oil profits, and we'll be the counterparty, because nobody will know who the counterparty is, because this is all over-the-counter hidden stuff. So we, the State Department, U.S. State Department, or whoever, the military or somebody, will be the counterparty. So we'll be flooding the money to you to pay off your derivative. And according to Catherine Austin Fitts, there's $40 trillion, I think, in the, or maybe it's $60 trillion. There's a lot of money in the black budget. So they've got the money to do it. So it all looks highly suspicious. But it was Citigroup that was pouring on the derivatives, the oil derivatives, when everybody else was pulling back on their derivatives, the other big derivatives banks. And it was Citigroup that pushed to get that last 5% waived so that it too could be covered by taxpayer money.
Well, and depositor money.
Yeah.
And do you think people realize? Because somebody sent me this. They sent it to me, and I went ahead and looked it up online independently myself. And this is from a big bank. This is a commercial banking agreement. It's from BB&T, and in here it basically lays out that they have no fiduciary responsibility to you, and you basically are a creditor. And I can't imagine that's the only bank that's done that. I mean, they've changed the rules. Deposit, that's not your money. You give it to them. You are loaning them the money. You are a creditor, and people aren't grasping that. Is that what you're saying?
Yeah, that's right. And now they have all this push for going all cash, for eliminating cash, so that you really don't even have the option of pulling your money out of the bank. Money is something that exists digitally in a bank today, pretty much.
And people say, well, I don't have more than $250,000. I'm insured. And I'm thinking, well, you're insured, but what will your money be worth if they have to monetize, just the insured deposits, $500 trillion, $10 trillion, whatever. I mean, there's payrolls there. There's all kinds of money at short-term in, multitude of banks. It's not just, deposits.
It's over $6 trillion is covered by the FDIC in deposits, but it's way more than they've got in the fund. They've got $67 billion in the fund, so That's like 1%.
What would your money be worth if they had to just print that money to say, oh, you had $100,000 or $150,000 or whatever? Oh yeah, okay, you're insured, and they just print the digits and put it in there. What would the money be worth? I mean, wouldn't that be the classic example of hyperinflation? Weimar Germany, here we come.
Well, personally, I think that is the answer. I think we should all have an account at the central bank. Once you put your money in, it's your money. When you want to pull it out, the numbers are there because it's the central bank, which has the power to create the digits. But it's really not necessary. When you borrow money, it's really not necessary that you have savers that put the money in there first. Well, that's a whole different topic. But it seems to me that we do have to redesign the entire banking system. And the ideal system was that American colonists in Pennsylvania in Benjamin Franklin's time. I think we need to go back to that again, where the bank is a public utility. The government creates the currency in the form of payments for goods and services. I mean, it's all connected to goods and services. If there's no goods and services, there's no money. That's how money comes into the system. And the government is the lender. So they have the power to control. Once your money's in there, it's there. There's no way that somebody else can tap it.
Well, speaking of goods and services, I mean, here's, you think, well, how could this, I mean, they're telling us the economy's great. And I just pulled this off Zero Hedge in a lovely little story that Deutsche Bank is freaking out about the perfect storm. And here we have the Baltic Dry Index. I'm going to go full screen on this. And then here we have, this is back in the 90s. Let's make sure I have that. Yeah, this is back in the 90s back here. Okay, and then here it is today, which is tanking. It's historic lows. The Baltic Dry. That means the goods and services aren't moving. That means people aren't getting paid. Isn't that a way to accelerate these derivative losses that you're talking about that could happen? That could basically wipe out people's savings.
Yeah, and the derivatives only go for a certain amount of time, and because it's all dark and it's all shadow banking. We don't know when these things might expire, and then suddenly those companies could go bankrupt.
And you're thinking that is this part of the scenario that you're seeing, that this could be sooner than later? That you're talking about people being wiped out, and in 2016, you're given that as a date. That savings could be wiped out, and here we are again. And if you look at this chart, here we are. This is the 90s again on the right side, right over here. This is the 90s over here, and here we are again, bouncing along this line. This was the 2008, little crash, and this looks really similar to, things are going down, and we are the manufacturing is shrinking, is stopping.
Yeah. Well, the reason I said 2016 was that in the EU, they are actually taking deposits as of January 2016. The reason this made the news was that in November of last year, a pensioner committed suicide after he lost 100,000 euros, his whole life savings, in his bank, where he had banked there for 50 years, but he had bought bonds, bank bonds. It wasn't deposit, but he wrote a suicide note. He hanged himself and wrote a suicide note blaming the bank. But he really should blame this whole system that has been adopted by the Financial Stability Board and the EU Banking Union, where they first have to bail in the creditors' money before they can touch their bailout fund, which is contributed, it's premiums from the various banks in the country. So in January, the reason that the Prime Minister bailed in these 4 insolvent banks then, before January, was that had he waited till January, many more people millions of people would have been, millions of savers would have lost their money. So that's what we have to look forward to, because the European banks many of them are very shaky. They rushed through that banking union knowing that those banks were shaky, and they wouldn't do stress tests until after they had the union in place, because they didn't want people to know how shaky these banks were. But it was supposed to be a 3-pronged deal, which would be bailouts, bail-ins, and deposit insurance, but they never got around to the deposit insurance. So they don't have Eurozone-wide deposit insurance. All they have is you have to bail in your creditors' money, which would include the depositors' money now as of January. Of course, supposedly over 100,000 euros, but again, you've got the problem of you don't have a Euro-wide or Eurozone-wide bail-in fund to pay that money. So all you've got for your insured deposits are what the premiums of the banks in the country, the pool of those put together by those banks. So if the pool doesn't have enough money, then you're out of luck. And if, like, it was up to our FDIC, we would be out of luck. They definitely don't have enough money to cover a big bust.
And you think this happens in 2016? You think the bail-in scenario for U.S. banks happens this year?
Well, it happens in Europe this year because they've said so. I mean, they've put it right in there that this is in January of 2016, they're going to start capping up the deposits. And over 100,000 euros is not that much. I mean, businesses keep that much cash around because they need to pay their workers. They've got payroll to meet. They've got suppliers to meet. So that's what happened in Cyprus, that it was largely the local businesses that got hit. They lost 50% of their money. And so they had to lay off people or close their doors, and the whole economy just plummeted after that. So it's very hard on the economy.
And you're talking about this being on not just a European level, but it could float right on over here across the Atlantic here to the United States, and these bail-ins are going to hit here eventually as well. And business is going to just get creamed. I mean, oh, your payroll, sorry, it's been bailed into the bank. The bank has it now.
Yeah. Well, we don't have a trigger like a provision that says January 2016, but we have the bail-in scheme built into the Dodd-Frank Act of 2010, and then there was the Financial Stability Board formalized this. The G20 formalized it in Brisbane, Australia, in November of 2014, and we have the Bankruptcy Reform Act of 2005 that says that derivatives go first. So our potential liability is much greater than even the European depositors.
Do you think it gets bad enough to where the whole system will absolutely shut down? Do you think the whole system will shut down over this? I mean, this article is written in very factual. You know, you lay it out, the Dodd-Frank, all the pieces of legislation that point to exactly what they're going to do. Do you think it could shut down the whole system?
It sure looks that way. I mean, I wouldn't like Paul Craig Roberts says, you always think it's all set to collapse, and they seem to manage to do something to prop it up. They can change the rules, or they can tap into their black budget. But nobody anticipated what happened in 2008, and that was a $700 billion bailout. Even if the FDIC tapped up its treasury line, that's only $500 billion. So things certainly could go wrong. And why are they rushing to put all these provisions into place? They're expecting something.
You think they're expecting something because they've got everything? Is everything set now? They can do the bail-ins. Everything's all set now, right?
Yeah, they think they have avoided too big to fail, but what they've actually done is formalized too big to fail. I mean, it's the end of capitalism. There's no such thing as too big to fail in a capitalist society, where you say that certain corporations can't fail and that you have to take the people's money in order to prop them up. That is no longer capitalism.
And you're a capitalist. You think that your money is your money, and you believe in property rights. Obviously, if it's your money, you believe in property rights, you're a capitalist.
Well, I do think there's I'm head of the Public Banking Institute, and what we want to do is publicly owned banks. So in every country, on average, something like 50% of the economy is publicly owned and 50% is privately owned. It's just a question of which 50%. For us, the big 50% is like the military. The military is our biggest socialist engine. It seems to me we'd be better off with publicly owned banks, which is just acknowledging that money is a public utility. It's our money. We, the people, back it. Clearly we back it. We're now making these banks too big to fail. We are backing these banks they are sucking the profits out like a parasite from the economy. If we are going to be supporting them, the profits should go back to the people. It should be the credit should be put into these manufacturing jobs that you're pointing out are being lost. Manufacturing is disappearing because the banks make more money on derivatives than by making loans to small and medium-sized businesses, which is where manufacturing comes from and where jobs come from.
Ellen Brown, before we close, I want to talk about your next book, book number 13. You have another book coming out. What's the working title, and when do you think it'll be out? What's it about?
It's called Infrastructure Without Debt. So it's basically about using quantitative easing for infrastructure. I mean, if we have this amazing tool of the ability to create credit, we should be using it for things we desperately need. Here we have this belief that we're in austerity mode, that there's not enough money around, but the Fed is the creator of money. So if you were issuing money for constructive purposes, like happened in the 1930s through the Reconstruction Finance Corporation, where you're actually funding businesses to pay the money back. So in the 1930s, there was all this credit that was funneled into roads and bridges and dams and, electricity and farms and things that paid the loans back. Over the course of 20 years, the Reconstruction Finance Corporation actually made a profit for the government. It was a government-owned financial institution because they couldn't get the Fed to do it. So they set up this other institution which was funneling credit, largely borrowed from the Treasury, so largely just created on the book, funneled to businesses, which then paid it back. It turned a profit for the government when it was finally shut down, and rebuilt the entire country. We could do that too. That's what the Chinese are doing. They just issue the credit. They build those amazing trains and all this infrastructure they're building. They're just issuing the credit, building the thing, and then the proceeds from the thing they build pay back the loan and balance the books. That's what I'm writing about. So we've got to get the credit out there first, and we have the tools. We can get credit out there. We're sort of blindly thinking that the government is broke and that they can't do all these things that we, the people, expect government to do.
Well, it's bail out the banks at all costs. Even if we kill every business and kill every bank account and kill all the credit, as long as we have the banks, it's okay. Lloyd Blankfein is a billionaire. He should have been a greeter at Walmart. I'm sorry, that denigrates greeters at Walmart. But he should have been a Skid Row bum. Lloyd Blankfein. He turned into a billionaire, and this is outrageous.
Yeah, I know. It's amazing, the system that we have. But the good thing is that people are becoming more and more aware of it, and I think that's the first thing that has to happen is we have to understand what's going on, and then we have to consolidate into a movement so that we actually have some power. The 99% obviously outnumbers the 1%, but we need to know what's going on and what would work. Right now, that even in the money reform movement, people are still arguing about what the solution is. I mean, I have mine, and then other people say, no, we have to do it this way, and so we have to iron all that out first. But we're at that very exciting place, I think, in history where we're actually designing new systems and thinking of what new possibilities there are.
Well, if you believe in capitalism, you believe in bankruptcy, and we've lost sight of believing in bankruptcy. And what's the working title? When do you think it'll be out, your book?
Infrastructure Without Debt. I'm so busy. I'm going to Europe in February. I'll be speaking in Iceland and Manchester, England, and Wales on public banking. And then I have some other things set up after that. So writing books is just not as fast as it used to be, but hopefully in the spring.
Oh, okay, Ellen Brown, ellenbrown.com, also her popular moniker, Web of Debt blog. Ellen Brown, thanks for joining us today on USAWatchdog.com.
Thanks, Greg. Always great to talk to you.